What's up, y'all? My name's Dave. I'm a financial advisor. I'm here to help you secure your future financial stability and therefore your freedom to live your life. Quick disclaimer, this is all free financial advice. Please follow it at your own discretion and don't sue me. Thank you. So today, as you can tell by the title of the slide, I'm going to be talking about the different investment account options and comparing those to retirement accounts. So the key differences between investment accounts and retirement accounts is mostly that retirement accounts have more rules and the investment accounts are pretty standardized. Um, in the retirement accounts, such as your IRA or individual retirement account or your 401k, you're going to get tax advantages because the government wants to encourage you to save for retirement. But there's also going to be contribution limits. They're not going to let you contribute an infinite amount of money in order to get all those tax advantages. They're going to cap you. Some of them are going to force you to start withdrawing money once you should be retiring. And all of them are going to penalize you if you try to withdraw money before retirement. So without further ado, let's get into it. The first type of account I'm going to go over, and the most basic, is the individual brokerage account. This is your vanilla ice cream of investment accounts. In these accounts, compared to a normal bank account, you can buy and sell investments like stocks, bonds, mutual funds, or exchange traded funds, or if you apply for the option and you're confident in yourself, even options. In these brokerage accounts, in your individual accounts, your investment accounts, all different words for the same thing, there's going to be capital gains taxes. So what does that mean? When you buy an investment and then sell it for a profit, the government taxes you on the profit you made, and that's a capital gains tax. The amount of that tax, the percentage of the profit, is going to vary depending on your tax bracket. And it's also going to vary depending on how long you held that investment, which is the long term versus short term. If you held that investment, generally speaking, for a year or more, then it's going to get taxed at long-term capital gains tax rates. And if you held it for less than a year, it's going to get taxed as if it was ordinary income. And the long-term capital gains tax rates are much lower than your ordinary income tax rates. So in general, for tax efficient investing, we want to hold our investments for more than a year. In these brokerage accounts, there are really no limits. There's no maximum contributions that you can put into the account, which is really just to say there's no max on how much you can deposit into the account. And you can also withdraw money from your account whenever you want, no penalties. Just need to sell your investments first. The first retirement account we're going to look at is the traditional IRA. IRA, again, is individual retirement account. In an IRA, you get certain tax advantages. In a traditional IRA, you make before tax contributions. What does that mean? Well, normally when we make money from our job, taxes get automatically deducted out of there. But instead of investing the smaller portion after the government's taken their taxes, in the traditional IRA, you can invest the whole of your wages before the government taxes it into your account. Why is that good? Well, the money that you otherwise would have lost to taxes up front gets to start growing for you in your investment account. Furthermore, while you're investing in your traditional IRA, there's no capital gains taxes. So while you're buying and selling investments, even if you're making a profit on those buying and selling, you don't have to pay taxes. But, in order to make sure that people are not abusing these accounts, there are contribution limits, right? The government will only allow you to invest $6,500 per year into your account, or the amount you made that year. If your wages, how much money you made from your job, is less than $6,500. And there's also early withdrawal penalties in traditional IRAs. If you withdraw before you're 59 and a half years old, then they're going to make a 10% penalty on that withdrawal, which sucks. Big ouch. which is why we should not be planning on taking any money out of our retirement accounts before 59 and a half. We want to avoid that 10% penalty at all costs. Moreover, there's also RMDs, or required minimum distributions, in traditional IRAs. What does that mean? It means once you're 72, there's a certain amount of money that you will be required to withdraw from your IRA every single year, which sometimes isn't a big deal for people, but it's something to keep in mind. Traditional IRAs are pretty easily compared with Roth IRAs. They're both individual retirement accounts. The chief difference between the two is the fact that traditional IRAs are invested with before tax money, while Roth IRAs are invested with after tax money. So what's the difference? Again, when you get your wages from your employer, in a traditional IRA, you can get the full amount of your wages put into your investment account. In a Roth IRA, the government's going to take their cut of your wages, the income tax, and then whatever's left, you can put into your investment account. But the tax advantage of a Roth IRA instead of a traditional brokerage account is that there's no capital gains taxes ever, right? While you're buying and selling in the account leading up until retirement, you won't pay capital gains taxes. And when you go to withdraw all of your money in retirement, you still will not pay taxes because you paid taxes up front. There's still contribution limits like the traditional IRA. The max you can contribute is $6,500 per year, or however much money you made from your job that year. If it's less than $6,500, there's still an early withdrawal penalty. If you withdraw your earnings or your profits before you're 59 and a half, then they're going to tax you 10%. But you can withdraw your contributions or the money you put into the account itself whenever you want. It's just when you start withdrawing your profits that they'll penalize you. Another big contrast between the traditional IRA and the Roth IRA is that the Roth IRA does not have any required minimum distributions, which means that you will not be forced to start taking money out of it once you turn 72. So which should I open, right? Should I open a traditional IRA or a Roth IRA? Well, you should open a traditional IRA if you're making more money now than you will later, because you want to pay taxes later when you're in a lower tax bracket instead of now when you're in a higher tax bracket making more money. And you want to invest in a Roth IRA if you're making less money now than you will be later, right? Because in that scenario, you want to pay taxes now when you're in a lower tax bracket instead of later when you're in a higher tax bracket. So really, the question to ask in whether you should invest in a traditional or Roth IRA is your income going up or down from here? If you're going to be making more money in the future, then you want to pay taxes now. So you want to do a traditional, or you want to do a Roth IRA. There we go. But if you're going to be making less money in the future, you want to pay less taxes later, so you want to go a traditional IRA. These individual retirement accounts can be contrasted with a 401k, which is employer sponsored. What does that mean? It means your company, out of the kindness of their hearts, but it's really because they got rid of the pensions, will offer you a retirement plan. Some companies will offer employer matching as a part of their 401k. What does that mean? They'll say, hey, for every $2,000 you invest, we'll match 2% of your money, right? And so once you invest $2,000 in the 401k, they'll calculate 2% and then put that in there as well. And that's basically just free money, right? They're offering to give you money if you invest in the 401k they're offering. There are contribution limits for 401ks. It's a lot higher than the IRAs. It's $22,500 per year. And there's still early withdrawal penalties like the IRAs. So I want to touch on one last distinction before wrapping up the video, and that's traditional versus Roth 401ks, the differences mirror the differences between traditional and Roth IRAs. In the traditional 401ks, there's pre-tax contributions, right? So you're just investing the whole amount before the government takes the taxes, and then the government will take their taxes when you try to withdraw the money. And there will be required minimum distributions once you turn 72 years old. In a Roth 401k, you make after-tax contributions, so the government takes their taxes, and then you end up investing it, and then you get tax-free withdrawal on the back end, and there's no required minimum distributions. So what's the path to optimize investing? Which accounts should I invest in first? Well, common wisdom, and obviously this is going to be different for most people, but common wisdom is to start with your 401k, right? Max out your company matching policy. Usually they're not going to match all the way up to the contribution limit of $22,500. It'll be lower than that. So you want that lower amount where they'll max out how much free money they're giving you, because that's free money, right? What's better than that? And then the second account you want to invest in is the IRAs for the tax advantages. And whether it's a Roth IRA or traditional IRA, depends on you, depends on whether your income is going up or down from here. And then you want to start investing into your brokerage accounts after you've maxed out the $6,500 contribution limit for the IRAs. But I put this picture in here at the end to remind me, this is different for everybody, right? I personally hope to retire before I'm 59 and a half. And so I can't put all of my money into IRAs because I won't have money to retire on then, right? And so I need to put more money into my brokerage accounts than most people would otherwise. And so I encourage you to talk to a financial advisor like me, in order to figure out what is your optimized investing, right? This is just general wisdom, but everyone's situation's a little bit different. But that's everything from me. Thank you so much for watching. Check the description below for my Linktree with the rest of my YouTube videos. If you want to receive updated investment advice relevant to the stock market today, then fill out the Google form in the description and mark that you want to be added to my newsletter. If you want free personalized financial advice, then fill out that same Google form and add me to your investment account as a view-only role. That will allow me to see but not actually do anything with your account, so I can give you free personalized financial advice. If you're unsure how to add me as an authorized viewer, then call the customer support phone number for your brokerage firm that you opened your account with, and I'm sure they'll be happy to help you out. And you may be wondering, why am I offering financial advice for free? Well, in 20 years, when you've made your money from this free investment advice and you're looking for a financial advisor to give you more comprehensive assistance, I want to be the first person you think of, and I look forward to embarking on that journey with you. That's everything from me. Congratulations on starting your journey towards your financial freedom, and I'll see you next time.